Simplified Barrier Income ETFs, SBAR and XV. We're going to do an overview of these, exploring structural income strategies through barrier options.
Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy, and today we're breaking down two newer funds. And they're unique funds. They're not brand new in the system, but they are used in a unique way. They're called barrier funds. And if you're not familiar with specified SBAR and XV, you're kind of missing something here. Both of these funds have downside protection and capped upside with some huge growth going into it, and they're income generating. It's almost like everything you've ever asked for. I got a 30% protection on the downside. I have income on a monthly basis. And then, of course, because it's a call option situation, we do have a cap side. But it helps generate that it prevents most of the downside losses. We're going to cover those today and help you out in your financial goals.
Guys, so important notice to everybody, this presentation was designed and provided to you by an educational purposes only and is not constituted financial advice. Educational purpose, no financial advice. Distributions are not guaranteed. The yields are subject to change without notice. And if you need any professional help, if you need questions on the financial stuff, always contact a financial professional. Don't just watch a YouTube video. Don't just ask someone who sounds like they're intelligent with it. Always ask a professional first. So the first thing we got to do is understand what barrier options fundamentals really are. And what it is downside protection. The barrier options provide protection only if the underlying asset remains above the predetermined level, like 30%, until expiration. Premium collection. Seller receives premiums in exchange for assuming a conditional downside risk, creating an income stream. And conditional loss exposure. Losses are only realized if the barrier is breached at expiration. Otherwise, the option expires worthless and the premiums are kept. So the path-dependent nature. Unlike vanilla options, barrier options payoff depends on whether the underlying asset touches the barrier level during the option's lifetime. So basically, if you bought a barrier option payoff structure, and you see it here, the full loss would be at 30% loss of the underlying asset. Everything above that is actually premium collected and income generating. Traditional versus enhanced barrier structure. Well, the traditional barriers that are out there, SBAR and XV, uses what we call an enhanced barrier structure. And we'll start off with the structure. Single asset barrier, while SBAR and XV uses a multi-asset worst asset. Now I want to get away from that worst name because everyone starts turning their heads like, oh, if you're selling the worst, why am I interested? Worst of reference assets is the barrier is based on the worst performance of the 3 U.S. equity segments, large cap, small cap, and growth, increasing the protection probability. The risk management, fixed barrier levels versus a dynamic barrier adjustment. Income potential, limited premium collection, enhanced through callability. The callability feature automatically determines and replaces the option when all reference assets achieve the positive returns, locking in the gains. So this is what makes these things really unique. You have a downward structure pre-planned. You have an upside positive return pre-planned and locked in to what these things can do. Expiration on a traditional barrier is a single expiration date, while SBAR and XV uses a laddered expirational dates. That means multiple options with staggered expiration reduces the time risk and enables seamless reinvestment. So then the counterpart risk is that bank credit exposure, and this one has minimal counterpart risk. So what Simplify's actually done is they've taken the traditional barrier style ETF and have really amplified it, modified it to make it work in today's times by giving you the laddered expirations, which is numerous number of different options, all achieving different expiration dates, making them all the callable feature, and then also working on the worst scenario that's possible and using that as the barrier. So SBAR and XV, the function and the fun architect is this: the laddered portfolio exposure that we talked about. Multiple barrier options that are staggered expirations, monthly, quarterly, instead of one single 12-month option. It's an automatic rolling. The options automatically replace upon maturity or call, ensuring continuous income generation without investor action. It's a continuous distribution, monthly distributions from option premiums, creating a steady income stream through the ETF's lifetime. And a dynamic management, active manage with feels like the worst of reference assets and callability to enhance the income potential. You look at each one of these and you can see this is almost like they do the laddered option. They will use the call and replace as funds start to die out. If they start hitting what we call that worst case scenario, or if they hit the top end, we reset it. The advantages over a traditional barrier product is, first off, the big difference is going to be liquidity. It's limited to redemption windows and the continuously exchange traded. The credit risk, the traditionals have the exposure to the issuing bank, and we have minimal counterpart risk because it's multiple different options. Now the tax reporting, again, Simplify did it differently. The complex K1 forms that traditional barrier products require, they have made it to where it fits into the simple 1099 forms. Expense ratio, barrier products normally have a high expense ratio, and these guys are using a typically lower barrier. So SBAR is a fixed barrier approach. It fixes the barrier at 30%, providing predictable downside protection. So again, it lowers the risk, it lowers your income potential, and predictable downside protection. Market-driven income not guaranteed. Now, XV uses a target distribution approach. The variable barrier amid and achieve a 15% annualized distribution. So the higher the risk, the higher the income potential. The variable adjustment to the market conditions and consistent 15% distribution targets. This is what makes these two different pieces approaching. The SBAR is the very conservative side. It's giving you that 30%. They're saying we will not lose more than 30% in the particular fund. If the market really crashes and we go below 30, that's when we're going to have our issue. XV is looking for income. They're the income-driven one. They're going to use the variable barriers amid all different type of option trading to trying to achieve that 15% target. Now remember, none of these are guaranteed, and targets are just a target for a company to shoot for. When we take a look under the hood of SBAR, the Simplified Barrier Income ETF, this thing has $203 million in assets, expense ratio 0.75, 6.95 million shares outstanding. Now this did come out on April 14th of 2025, so we're a few months away from 1 year across the board. We look so far, they are projecting out about a 12.91% dividend yield is what they're working with. So far, 100% collected in dividends, we're at 8.47. So we're not that far off, collecting $2.24 in distributions. It does pay out monthly. And when we take a look at this, the growth of the fund is up 5.65% since the inception date. So this thing has a slow trend moving up. We did not see, we saw a little bit of a drop off in November, but nothing through December, and definitely nothing at the first of the year. Since inception, the fund has actually showed a 19.69% total return and a 1.15% over the last year to date, so which is what, 26 days so far, and 0.99 for the month. Total return that we have seen over the past, we call it the past 1 year, is 15.11%. So the numbers are dialing right into a very secure fund that it's way above the barrier. So I don't see a worry of hitting that barrier. And again, income generating fund. When we look at XV, the targeted 15 for distributions, well, this thing is right on track, guys. I don't even see this. Assets 69 million, expense ratio 0.75, 2.7 million shares outstanding, and already so far since April, this fund has paid out 14.83%. That's $3.81 so far. Now, because of the price drop off that they had, they are projecting a huge number in distributions, which we already have said, that's all because of that big number. That if you look on their website, they'll show you about a 71% potential in the distributions. We're kind of keeping this thing in line, saying where are we actually going to fall into, because that 15% is their target. They will make adjustments accordingly. But I will show you one big thing in the next slide that's going to give you the reason why they're showing such a big number. But you're seeing a 2.89% growth and then an 18.93% total return since April. Since inception, 24.78 and 1.26 and 0.71. Again, their variable barriers are really proving that they've stopped any kind of losses. They've performed very well, and this is an income unit. So here's what I'm talking about in the distribution. Start off with SBAR, 28 cents each and every month. Very, very steady, very controllable across the board. Simplified target 15 distribution, they have been at basically right around that 33 cents. And then this last month, they had a huge payout of $1.50. Do we expect to get the $1.50? No. This is what basically they call a clean out. They have a cleanup of the funds. It'll come right back down in line. That's why you saw that drop off earlier in the pricing. It will come back down to that about 33 to 34 cents per share and reevaluate itself as it goes along. As some of their options clear out, you may see a clearinghouse again come into effect. So the portfolio implementation strategies, SBAR and XV serve as multiple strategic roles in a portfolio construction, offering income, risk, migration, and diversified benefits. Income generation, let's talk about that first. The yields are significantly higher than traditional fixed income products. Monthly distributions from option premiums provide a steady cash flow. Can supplement or replace interest income of treasury and bonds, and particularly variable in low yield environments. The risk manage enables a 30% barrier, provides that downside protection. This is why we see that this, and I would personally use this in my stability fund, basically building my stability across the board. You have that 30% barrier that nothing happens until you hit that barrier of losses. In worse performing references, assets remain above the barrier, the fund avoids full market losses. And the income from those premiums cushion the losses during market declines. And it's an effective tool for reducing portfolio volatility and protecting your capital. Portfolio diversification, the barrier options introduced non-collateral return stream. The performance driven by option premium income and the path-dependent barrier events. Enhances the portfolio diversification, particularly effective in volatile markets and low call rate between option-based and income in traditional asset classes. So the allocation consideration is this. The balanced allocation strategy, SBAR and XV, can be used in a balanced portfolio risk profile, combining the stability and the fixed income with an income and diversification benefits of a linked strategies. The source of the stocks. When the source from stocks, SBAR and XV, reduces the portfolio aggressiveness and enables barrier limits downside while providing income. This can help stabilize equity-heavy portfolios. So it's a safety tool that we're using in retirement portfolios. Sourcing from bonds. When sourcing from bonds, the higher income of SBAR and XV can be reinvested or used to offset bond duration risk, effectively increasing the portfolio aggressiveness in a controlled manner. And of course, the enhanced income profile. A balanced allocation from both asset class can yield a relatively neutral risk while providing enhanced income. So the market environment performance, the best class, the moderate decline. Market declines moderately just above barrier. You avoid the downside exposure. You collect full premiums and strong relative performance. The worst case scenario is a severe downcline. The market falls well below the barrier level at the expiration. It suffers full market loss. The premium income will help offset any of those losses better than direct equity investments. So what are they saying there? If the market drops 30%, the underlying asset has to drop full 30% before we see market loss from the fund. Once we see that 30%, you've already collected all the income, which will help recover your losses, so you won't take the full 30% hit like if you did in a stock or another basically plain out ETF. Better than direct equity investments. If we're in a neutral or a bullish markets, strong bull markets where upside is capped, underperforms equities. It provides income, may not be compensated. Less suitable in bull markets. So what this thing is designed for is the moderate and the worst case scenarios. This is why we say this is the protective piece in a portfolio. So barrier and buffer funds. Barrier funds, again, are contingent on the barrier remaining unbreached. Buffer funds are non-contingent, guaranteed up to a buffer level. Okay? Loss capping. Full loss if a barrier is breached, none if it's not, and capped at a specific buffer level. So this whole thing comes into the difference between a barrier and a buffer is the buffer side of it. And I'm using it down at the example as the easiest one to explain. A 20% barrier equals 20% protection and higher income. A buffer says you have 20% protection, but you have lower income. Okay? So the buffer has it that once the buffer hits, the protection guaranteed to the buffer upper level. So it's, again, it sounds confusing, but you're protecting. You're in a barrier. You're protecting your downside and leaving your upside to have more higher income because you're constantly selling options based. While the other buffer program is protecting your downside, but it doesn't generate the income. So share fluctuations. These are questions that get asked all the time. When share prices decline, SBAR share prices also decline as option values are marked into the market. However, as option approaches expiration, if the reference asset remains above the barrier, the fund's share prices will increase. Okay, because there's extra value that you have in there that the fund is marked at a 30% loss. And if you're above that, you're generating more income. Option call mechanism. When a call option gets called, the barrier put option is replaced with a new one. So it's like even if you hit that call option level, They're instantly putting another option out there to replace that because the barrier is then reset at the new levels. And the 12-month time to expiration begins again. So you're constantly putting in new options over and over, continuously generating income, and you have 12 months working within that parameters. The barrier versus buffer funds. Barrier funds are contingent on the underlying asset remaining above the barrier level, while the buffer provides non-contingent protection. Barrier funds typically offer higher income than buffer funds because the seller assumes a higher probability of the loss if the barrier has been breached. And market environment performance. The worst return occurs when the worst of the asset returns drops below the barrier expiration. The best returns are achieved when the worst of the asset remains above the barrier, allowing the fund to collect full premiums while avoiding downside exposure. So really here we go with the key benefits. Enhanced income potential through a laddered barrier options, liquidity and continuous trading in major exchanges, lower credit risk compared to bank-issued structured notes, and simplified tax reporting of 1099s. The risk factors: market exposure if barrier is breached, complexity of option pricing and barrier mechanisms, capped upside and strong bull markets, and timing risks associated with option expirations. For investor stability, the conservative investor, SBAR's 30% barrier provides a higher downside protection. Income-focused investors, XV's 15% target distribution with a higher risk. Portfolio diversifies non-collateral return streams from option premiums income and market environment, best in range of bond markets and maturity volatility. So overall, how do you see that these things fit? Are these an interesting piece? Like I said, I like them in a portfolio, of a retirement portfolio, using it as my security, using it as my, I call it the foundation side, that I have income coming in from money sitting in there, and I have barrier that the 30%, as long as the market doesn't drop that 30%, I'm happy, I'm moving forward, we're doing a good job. Putting a little bit into XV for more income, that's increasing more risks. That may go into my income side of it, but realistically, SBAR is where I put it in my conservative, and I'm not afraid to say XV. Let me know your thoughts. Let me know if you understand exactly how this thing works, and we may do even more on the simplified ETFs. Let me know. Simplified Barrier Income ETFs, SBAR and XV. We're going to do an overview of these, exploring structural income strategies through barrier options.